Hello students, today we are going to continue with where we left off. The new topic which we're going to learn about is a charge against profit. So what are charges against profit? So these are expenses which have to be paid by the firm in case it is earning a profit or incurring a loss. So in either case, what are they? They are expenses. Charge against profit is an expense. It has to be paid. By who? By the firm. When does it have to pay? When it is earning a profit or it is incurring a loss. In any case, this has to be paid. Now, where do we write these things? These charges against profit, where do we show them? So it is shown in the P&L account. Okay. Normally, if you consider this term, these are some charges which we have to pay. These are some expenses we have to pay, which is paid to outsiders. We have to consider these people who we are paying this off to as outsiders. The people who are working inside with us are our other partners. So the people who are working outside our business, those people's expenses are termed as charges against profit. The first of them, which we're going to study now, is interest on loan by a partner to the firm. Okay, so the first of them is the interest on the loan by the partner to the firm. Think about this. This is going to be an expense. If the partner is given a loan to the firm is required to pay back that loan amount. But apart from that loan amount, we are also talking about interest on that loan. So that interest, we will see what kind of a nature is it of? It is of an expense nature. So let's understand this. Say we have a firm and we have a partner. This is the partner. This is the firm. Now we are saying the partner is given a loan to the firm. So the partner is given a loan to the firm. So suppose we have given a loan of 1 lakh rupees to the firm. Why have we given it? Maybe the firm is requiring money. Instead of taking it from an outsider like the bank or from anywhere else, it asks its own person who is a partner. And that person had enough money, so that person willingly gave 1 lakh rupees. Now, when it's taking money from this partner, it also has to pay back interest on this loan. So right now, before we talk about the interest, when it is taken a loan of 1 lakh rupees, what is it creating for itself? It's creating a liability. Suppose we have taken this loan at the rate of 10%. So how much is 10% of 1 lakh? 10,000. So 10,000 over here is going to be the expense. Okay. So altogether, how much is this firm required to pay back the partner? Finally, 1 lakh plus 10,000. But right now we are talking about an expense. That's what our charge against profits. They are expenses. So we're talking about the expense. So which is the expense part of this 10,000 rupees? We are going to write journal entries for noting down this expense of this firm. So what are the journal entries? The first is when this interest is actually allowed. For that, we have to write a journal entry. So what is the journal entry? On allowing the interest, on allowing the interest on the loan by the partner. The journal entry is interest on loan by the partner, account debit, whatever may be the amount. 2. Over here you have to note it is loan by partner account. Okay, this is also referred to as partner's loan account. Okay, so this is the journal entry which we have to remember in this case on allowing the interest on the loan by the partner. This is the journal entry. Interest on loan by the partner account debit to the loan by the partner account or partner's loan account. Okay, the second journal entry in this case, when will this entry come? At the year end. The second journal entry will come at the year end. At the year end, to close the interest on loan by the partner account. So the second entry which we have to now know that is going to be P&L account debit, whatever may be the amount, to which account was opened and has to be closed, interest on loan by the partner account. So to interest on loan by the partner, and the amount is here. So this is the second entry. When do we do the second entry? At the year end. Why do we do the second entry at the year end? To close the interest on the loan by the partner account. Because in the first entry, we actually created. We are allowing the interest on the loan by the partner. So to allow that, we are creating a new account, which is interest on loan by partner account. And to close it at the end of the year, we have to credit it. Now, 2 points which I want you to keep in mind about this. The first, this interest is charged at the rate of 6% per annum if not mentioned. Remember, yesterday we were studying this, and yesterday we spoke about the interest. We said that if the interest is not mentioned in the partnership deed, partner is entitled to get the interest at the rate of 6% per annum. But in our example, which we considered here in the right side of this page, I gave you already an interest rate of 10%. So that is already given to us. So that is good in a way. But if this 10% was not mentioned, the rate would have been taken as 6%, and the amount as an expense would have been 6,000 in that case. The second point which we must remember here is this will be paid even in case of losses. This amount is paid even in case of losses. So if the firm has made a loss, even then the firm has to give the partner interest on the loan that it had taken from the partner. It has to arrange for it from somewhere, that money. Okay. Another point which I want you to note here is we have credited in this a partner's loan account. So partner's loan account is credited, not the partner's account. Okay, this is something which you have to also keep in mind, that the partner's loan account is credited and not the partner's account. We'll see about this once we get into more detail of this chapter. We'll understand this point better then. So we'll go to the next point, just the opposite of this. In the first case, we saw that the partner gave a loan to the firm. Now, in this case, we'll see what happens when the firm gives a loan to the partner. If the firm gives a loan to the partner, so under this case, again, there are going to be two journal entries. If you want to understand it in the same way. You have a partner, you have a firm. I am saying the firm has given a loan to the partner at the rate of 10%. Say the amount was 1 lakh. So for the partner, this 1 lakh is going to be a liability because it has to pay it up. He has to pay it up. And since there is an interest which is going to be charged at 10%, that is 10,000. This 10,000 is also going to be an expense. Now this is in terms of the partner. But if I talk in terms of the firm, from the firm's point of view, it's going to be an asset because it is given a loan to somebody who is a partner. Giving money, which it will get back later, will be an asset for it. And it is going to charge interest. So this interest which it is going to get will be an income. Okay. Now we are talking about the interest part because we are talking about items which are going to be linked or items which are going to be written in a P&L account. So we're going to either talk about expenses in this topic that we have started today, or we are going to talk about incomes. So right now this is an income. We are talking in terms of the firm's point of view. So for the firm, this is an income. So again, in this case, we are going to have two entries. The first of the entry, let's write it. For charging the interest on the loan to the partner who has been taking the loan. Partner is taking the loan. So who will we charge the interest on? We will charge it to the partner. So for that, we have a journal entry, the first journal entry, which is going to be partners capital or partners current account debit, whatever may be the amount. In this case, we are seeing it is 10,000. 2. Interest on loan to the partner. interest on the loan to the partner account. So what does this mean? The partner's capital account or the partner's current account is debited. For now, don't get confused with partner's current account that is mentioned. We'll understand this once we start to study a little more of this chapter. For now, just think about this to be a partner's capital account. So partner's capital account is debited. Why is partner's capital account debited? Because when the partner has taken a loan from the firm, he is going to pay back some amount as interest. So for him, it is an expense. It is a liability also to take a loan. So when he's taking this amount, his capital balance will reduce. So we are going to reduce his capital balance by debiting that account. Partner's capital account is debited. And what is this for the firm? For the firm, this is an income. That's why we are crediting it. So to interest on loan to the partner's account, we put that amount there. If I talk in terms of firm, the firm is maintaining the partner's capital account. So why have we debited the partner's capital account? Because eventually the firm is supposed to pay back the partner his capital. For the firm, paying back the partner his capital is a liability. So having the capital account debited means the liability of the firm to the partner is decreasing. So by writing this journal entry, we are actually reducing the liability which the firm has to pay back to the partner. Okay. So this is the first entry. The second of them, for transferring the interest on loan to the partner's account. When do we do this? At the year end. Just like in the last case we studied, we did it at the year end, the second entry. So here also at the year end, we transfer the interest on the loan to the partner's account. So what is the entry for that? Which account will close? The one that we opened temporarily. To interest on loan to the partner account will be closed over here. So let's write that entry. Since it was debited, it was credited, sorry, in the previous entry, now it will be debited. So interest on loan to the partner account is debited with whatever amount. In this case, what is the amount? 10,000. To which account will be credited? Where are we transferring it? We're transferring it to the P&L account. So to P&L account, and we put the amount. So what is happening here? P&L account is showing that there is an income because of the interest which the partner is paying back to the firm. Okay, so this is the second entry. Now let's come to the next charge against profit. We have done one, and this was just the opposite of that. Now the second one which we're going to do is the rent paid or payable to a partner. Rent paid or payable to a partner. Let's understand this. Suppose we are the partner and there is a firm. Partner has some property. Say the partner has land. The land is given to the firm for its use. So if it's given to the firm for its use, the firm may have to pay rent for that. The firm is going to pay rent to the partner for the land that it is taken from the partner, maybe to run the factory or maybe to run the business, whatever they are doing. So now this kind of rent which is payable to the partner by the firm, we are talking again in terms of the firm. So for the firm, this rent is going to be an expense. If it is an expense, this expense is going to be written on the debit side in the P&L account. So this is a charge against profit. The second category of a charge against profit is rent paid or payable to the partner. Let's see the first entry among this. The first is when the rent is paid. When the rent is paid in cash. So my entry would be rent account is debited. Rent account debit, whatever may be the amount. 2, it's paid in cash. So 2, cash account. If it is paid by bank, by a check, so I will write to bank account. I'll put the amount here. So say over here, we took this land which is worth 1 lakh rupees and we are paying rent of 10,000. Again, the same case, just like we studied some time back. So when we are paying rent, this is an expense. The land taken has to be returned back to the partner. So it would be a liability for the firm to pay back, to give back. Now this is when the rent is paid. Suppose the rent is not paid. That means it is outstanding. So if it is outstanding, what will I write? Again, I'm going to create an outstanding rent account. So or when rent is not paid, that is payable. Not paid means it's payable. So in that case, what's my journal entry? Rent account debit to outstanding rent account. Why? Because I'm creating a new liability for me, which is outstanding rent. And my rent account is already debited. So the same way I'm going to debit it here. Okay. Now the second entry, which we have to show. When is the second entry shown? At the year end. Where do we show these expenses? In our P&L account. So at the year end, we transfer this amount to the P&L account. Okay, so now what's the entry to transfer it? It's an expense for the firm. We saw over here, we've written it. So if it is an expense, it has to be shown on the debit side in the P&L account. So I will write P&L account debit to rent account, and whatever is the amount. So we have decided that this example gave an amount of 10,000. So we would have written 10,000 in these two places of this journal entry. All right, so these are the two journal entries which we have to show. Now again, this rent which is paid or which is payable to the partner is a charge against profit. It has to be paid. Okay, before you distribute your profits to the partners, all these expenses which have to be paid are charges against profit, and these have to be paid definitely. whether the firm is incurring a profit or getting a loss in both of the cases. Let's come to the third one. The third charge against profit, which we are going to be showing in our P&L account. The third charge against profit is called manager's commission. Now, we've seen about this in class 11. We've seen how we had to calculate manager's commission on the net profit before charging such commission, on the net profit after charging such commission. So here it's the same thing, and it is again a charge against profit. The manager is again an outsider. Definitely he's an outsider. He's not a person. He's not a partner of the business. So he's an outsider. He has to be given the money, and this also will definitely have to be given whether the business is earning a profit or incurring a loss. The manager's commission is again a charge against profit. Now we have some entries even corresponding to this. The first of this entry is going to be manager's commission account debit. The first of this entry is going to be manager's commission account debit to cash or bank, to cash account, whatever may be the amount which we have pre-decided, or to bank account, this is in case it has been paid. Now suppose it has not been paid. So in those cases we will write manager's commission account debit to outstanding commission account, and we'll put the amount, whatever may be the amount. The second entry which we have to pass in this case, when do we pass the second entry? At the year end. So where do we show this? We will show this in our P&L account because it is an expense. P&L account debit to managers commission account. Okay, so these are our three charge against profits, and these are the ones that we are supposed to know. These are our three expenses which we are supposed to show. The first was about the loan, the interest on the loan. The second was about the rent. The third is about manager's commission. Now we'll do the difference between these two kinds. But before that, let's talk about another account, which is called a P&L appropriation account. We'll do a difference between a P&L appropriation then, and we'll do between the charge against profits. So let's talk about a P&L appropriation account. P&L appropriation account. So what is a P&L appropriation account? This is just an extension. It's just an extension to a P&L account. So what does that mean? Through a P&L account, what do we get? We calculate our net profit or our net loss. Calculate our net profit or our net loss. Now think about this. Partners, after you've paid off all the outsiders, like we saw the charges against profit, and I told you these are paid mostly to the outsiders. So when you pay off your charge against profits, you're left with a certain amount of money. This amount of money now which is left will be distributed among the partners. So we show all our charge against profits in our P&L account. So after removing the charge against profits, what are charge against profits? Expenses. Which have to be paid. Those are for sure that we have to pay them. So after removing the charge against profits, we are left with our net profit or our net loss in our P&L account. So after we are left with our net profit or the net loss, we further divide this. Then what do? We divide among the partners. Now, when you divide this among the partners, there could be situations where you are also giving salary to certain partners. You are also giving interest on drawings, or you're charging interest on the drawings that are done by the partners. Or you're giving interest on the capital. Or you're giving a partner a commission. All these can be some situations which we are talking about. And then whatever is left after we give out all these, we are going to say that we are left with whatever balance, that balance would be distributed amongst the partners. So I'll give you a little more explanation about this by making a little account which is called a P&L appropriation account. Before that, why did I mention all these things here? These all things are called your appropriations. And what are appropriations? Appropriations means divisions. Appropriations means our division. Like if I make an account now, we have two sides again to the account. What I said was after we have given all the charge against profits, we are left with a balance which comes from our P&L account. And that balance is brought down in our P&L appropriation account. So suppose we earned a profit of, say, 1 lakh rupees. 1 lakh rupees was our net profit. Net profit comes from our P&L account. So to bring it in our P&L appropriation account, we will write it on the credit side, because in our P&L account, we must have written it on the debit side. So here I'm going to write by net profit. Okay. In brackets, you can write this, or you can also write it as by P&L account, because we are bringing it down from the P&L account. So let's write by P&L account, and then in brackets, we'll write net profit. This way. So whatever may be the amount, what am I saying? It is, suppose 1 lakh. We are supposed to be writing 1 lakh here. Okay. Now think about this. P&L appropriation account is prepared to divide the amount of profit which you've got from your P&L account after giving out all the charge against profits, after showing out all the expenses, whatever remaining profit you have left, and in this case it is 1 lakh. This you are supposed to divide between the partners who are there in your firm, in your business. Now, apart from this money which you have got here, you may have also let these partners take drawings from the business. So if they take drawings, where will I write the interest which is charged on these drawings? This again we are making in terms of the firm. So in terms of the firm, what is it? Interest on drawings. Interest on drawings for the firm is an income. So we will write it on the credit side. The second item which we will write will be interest on drawings. Now let's say in our firm we have three partners. Okay, and all three had withdrawn some money, which was the drawings. Let's say the partners' names are X, Y, and Z. X had withdrawn 500, Y had withdrawn 500, Z had withdrawn 500. So altogether they have withdrawn 1500. Okay. So interest on drawings will come on the credit side in my P&L appropriation account because it's related to the partners. Partners are paying you the interest on the drawings. So altogether now today you may have had 1 lakh plus 1500 rupees. Now let's talk about the expenses which this firm in whose position we are preparing this account. So the first expense which we will show would be to interest on capital. For this firm, the first expense will be interest on capital. Let's say there are three partners again, and all three are getting interest. And let's say the interest is 1000, 1000, and 1000. So altogether it is 3000, which we will write in our outer column. Among them, let's say one partner is going to be given a salary. So two partners salary. Which partner are we giving? X. So let's write his name in brackets. We are giving a salary of 1000 rupees. So this is going to be an expense again for our partnership firm. So we'll write it on the debit side. Next item, let's say we're giving commission. So two partners, commission. Which partner we are giving commission to? Let's say we, in our partnership deed, agreed to give Y a commission of say 500. Next item, what other expenses can we show in this? We can show to reserve. Why do we write to reserve? Maybe there is some amount which we are transferring to a reserve for any reason. Why do we create reserves? To use that amount in future. So let's say we are transferring 500 more here. Okay. These are the items which we are going to show in our P&L appropriation account. Now we have to balance this account. So which side is coming more? The credit side. So the amount is coming as 1,01,500. 1,01,500. So on my credit side, I've written that. My debit side also I'll write. And I'm going to be left with a balance of 1,01,500 minus 3,000 plus 1, 4,000, 5,000. So 1,01,500 minus 5,000 makes it 96,500. So 96,500 is my amount which I have to write here. This is my balancing figure. Where do I transfer this? This is going to be transferred. So I will write to transfer to partners capital account. And since we have not set any ratio, we will divide this equally between these three partners, X, Y, and Z. So how much is this division? We'll just see how much is this division coming on to. 32,166. So 32,166, 32,166. Let's make this 32,167. This is our total, and this will be coming. This will be a balancing figure. Okay. So what do we understand by this P&L appropriation account? It means that initially we will be left with a balance which is coming to us from a P&L account, which is the net profit. We write it on the credit side because this is an extension to the P&L account. After that, we will show interest on drawings again on the credit side because for the firm, this money is coming into the firm. The interest on drawings, which is just charging from the partners. We come to the credit side items. The first item is to interest on capital. Say there were three partners, each of them I have to be paid 1,000 each as interest, so the total is 3,000. One partner is to get a salary of say 1,000, so we have written it. Again, this is an expense. Partner may have been decided to give a commission to, so 500 rupees is the commission here. Then we have also decided to transfer some amount to the reserve, so we have written that amount. We are left with a balance which is 96,500. Again, this is left on the debit side. Just like a P&L account, if a balance is left on the debit side, it is a net profit. So this is also going to be known as a profit. That's why we are transferring this. So I'm going to write it here. This is a profit. This profit is going to be transferred to the partners capital account. Which are the partners? X, Y, and Z. And how are we going to divide it if nothing is mentioned? We're going to divide it equally. That's why I divided this amount equally and put the total in the outer column. This shows our P&L appropriation account. So why is the P&L appropriation account made? It's to transfer the net profit to the partner's capital account. So you see this last balancing figure which we have got over here. This is the reason why we make a P&L appropriation account. This is the main reason, to know how much profit is going to the partner's capital account. All these other items which are mentioned on top, we have to remember them as they are mentioned in this figure, what is displayed on your screen, in the same order, if it can be remembered, because it will be easy to solve questions in that way. Now let's do a little difference between a charge against profit, and an appropriation of profit. When I say charge against profit, all these charges are debited. All the charges debited to the P&L account. All charges against profit are debited to a P&L account. Appropriation of profit. These are debited to a P&L appropriation account. Okay. Now, another difference which we find is it is shown before appropriation of profit. So before we make a P&L appropriation of P&L appropriation account, we have to show our charges against profit in our P&L account. This one, it is appropriated after showing all charges against profit. Okay, some examples you can put. And what does this charge against profit help you to determine? This helps to determine the net profit or the loss of the business. Okay. And the appropriation of profit, what does it help you to do? This helps distribute the net profit among the partners. Okay, so you see the difference. A charge against profit is always shown on the debit side in a P&L account. Appropriation of profit is shown on the debit of a, sorry, it is shown in the P&L appropriation account. It is not that it is always going to be shown on the debit side. You will have something even shown on the credit side, like you have interest on drawings. Charge against profit is shown before the appropriation of profit. We are showing this in our P&L appropriation account, in our P&L account. So it is shown before the appropriation of profit. Appropriation of profit, on the other hand, is shown after all the charges are shown against profit in our P&L account. And the last is, it helps to determine the net profit or the loss of the business. And appropriation of profit helps us distribute the net profit among the partners. So we'll stop here. We'll continue in our next class and we'll see the further topics then. Thank you.